Hello everybody, a video on the fundamentals and mechanics of the SPX DTE0 strategy. Greeks that are important. Delta, used primarily as a guide for establishing the strike price. Theta, time decay of the premium associated with the option contract. Vega, the expansion or contraction of Vega will have a positive or negative impact on your trade. And Gamma, I think of this as the frequency of the asset, and the closer to the expiry, the more the price ranges up and down. Further out, Gamma has less impact. On DTE 0 days, Gamma can create havoc. Premium decay. So, as everybody probably knows if they've been trading options, time is the best weapon for those of us that are selling premium. And as you can see from this graph, the option decay accelerates the closer that you get to the expiration date. And so we, on the DTE 0 trading strategy, are seeing the most time decay in the shortest period of time. I think this gives us a great advantage. Okay. So why this strategy? The SPX is an ETF that has options that expire on a Monday, Wednesday and Friday of each trading week. The theta decay is significant in these final few hours, and a delta neutral strategy, such as an iron condor, combined with short selling of options to obtain premium, is ideal for this environment. One other thing, the SPX will move within a certain range each day. By selecting the strike prices above and below that range, calculating the expected market move, average true range and delta, it is possible with a high probability of success to bracket the market each day and return a profit. And here is a screenshot of the Thinkorswim expected market move figure. And as you can see from this example, at the beginning of the day, the SPX is expected to move 53.535 points on that day. Now, bear in mind, this is an approximate value. However, it can over time give you an 80 to 90% accuracy. So, profitability. What is the profitability of this strategy? Well, based on using deltas between 5 and 8, we can expect a strategy probability of profit of between 80 and 90%. Combine that with a 3 times stop loss, and the expectancy is calculated below. So, credit per trade, $200. So that's the credit that we take in when we open the trade. If we set the stop loss at 3 times the credit, then the stop loss will be $600. If we have an 80% win rate, which is on the lower end of the spectrum, if we were to have 80 wins, that would be $16,000. If we were to have 20 losses, that would be $12,000. And so, over the period of that 100 trades, we could expect a $4,000 profit. So what do I actually do every day that I'm trading the DTE 0? So in terms of execution, before the market opens, I will have a look at the market direction or bias. For example, the overnight futures market. Has it moved up? Has it moved down? Or has it moved sideways? Are there any significant macroeconomic events that are coming up that day? What is the geopolitical situation like? Examples of the geopolitical situation could be Ukraine, Brexit. Examples of the macroeconomics that affect the SPX. It could be such things as employment reports or the Federal Reserve issuing bulletins on interest rates. So once I've established a bias, I will then avoid trading the first 30 to 45 minutes. I've noticed that the market needs to open and sort itself out for the day. A lot of times trades can be stopped out very, very quickly in the first 30 to 45 minutes because the volatility is so high and the gamma is so high. So I won't look to be placing my trades between 45 and an hour into the trading day. Strike selection. I find 8 delta for both call and put legs is ideal. A good balance between premium captured and probability of profit. Here is a screenshot on Thinkorswim of a strike price and the delta. So once the trades are in, what do I do? Okay, so as soon as the trades are in and live, I will then set an OCO order in Thinkorswim. OCO stands for one cancels the other. And what I mean by that is I'll set a stop loss of 3 times X, but I will also set a buyback of $10. What does that mean? Okay, so the stop loss, if I get a credit of $200 and the option price reaches $600, stop loss kicks in and the trade is closed. If, on the other hand, the contract reaches a price point of $10, then also the trade will be closed and I will take the $190 credit. So it's kind of a either or. If one happens, then the other is cancelled. So once the Iron Condor is established and the OCO orders are in, I will then move away and let the trades run for a period of time. What I also tend to do is place an alert on these strike prices, and I will receive an email alert if it looks like either of the strike prices are going to be breached. Stop loss is triggered. Well, in my previous option trading history, a stop loss being triggered would be really negative for me. But what I find in these DT0 trades, it's not a big deal. If the trade is stopped out, then it just creates an opportunity to get back into the market. So let's take an example. I've set an 8 delta put spread and it gets stopped out. If I then look at the market and look at the next 8 delta, that is going to be a significant move away from the stopped out trade. So my belief is that if I get stopped out once in a day, it will be very, very, very rare that I get stopped out again in the same direction. That said, I will tend to, before I move back into a second leg, or a second trade I should say, just want to look at the price action and see if they're starting to form some sort of resistance before I get back into the trade. So if one of the legs has a stop loss triggered, I will look to re-enter using the same criteria as before. What is the expected market move, the delta and the ATR? And then I'll look to the price action and look for any indication of a reversal from the direction in which the stop was triggered. On the other side, the unchallenged side, it's probably going to be taken off for a profit at that stage. So I will have a stopped out leg, and I will also have been able to take off the other leg for a profit. And so then I'll be looking to build a replacement iron condor, or if the unchallenged side is still live, I will just simply look to add the stopped out leg. So once the iron condor is back in again, both legs, I will look to build a second iron condor, which will allow me to take in more premium and offset the loss of the stopped out trade. The second iron condor will also be placed using the same criteria: market direction, ATR, expected move, and delta. Now from experience, once I've reached the first stop out, this is around about midday, maybe a little bit before, this is normally when the theta decay starts to kick in and the market tends to settle a little bit. If I feel confident in the last 2 to 3 hours, I will then place a third trade, a third iron condor. However, this will normally just be if I'm not confident on the unchallenged side, and usually to bring the delta back to a more neutral position. Hedging. If the market is showing signs of extreme volatility, I will place a hedge trade. This will normally be a butterfly or credit spread, and usually in a bearish direction. That's because most of my risk is to the downside. I also have a weekly and monthly hedge trade for black swan events. These are more strategic and will comprise long calls on the VIX. I talk about delta neutrality because that is really important on this strategy. It's important to keep the price as neutral as possible. And here is an example of the Thinkorswim Analyze tab, where you can see the prices here of the asset, and my break even to the put side, and my break even to the call side. And it is really critical that you keep this right in the middle. And if you see it starting to drift over to the put side, then that's where you start to manage on the call side. So maybe adding more calls on this side, taking some calls off for profit, etc. Vice versa, if you start to see pressure on this side, then you just add to your put side to balance it out. Okay, very, very rough and ready explanation of my strategy. I'm not going to take credit for this entirely. I have done some research and I have looked around and studied some YouTube videos about DTE0, and I've taken some advice and guidance from many YouTube, Facebook sites, etc. So what I've tried to do is just combine a number of different processes or procedures into what I'm doing today. Okay, thanks very much. Appreciate it.